Have you ever looked at a journal entry and just your brain freezes? You feel like you're trying to crack some kind of secret code. Well, you're definitely not alone. But what if I told you the secret to finally understanding debits and credits is actually, well, it's incredibly simple. Stick with me, because in the next few minutes, we're going to unlock this thing for good.
Look, it doesn't matter if you're a student trying to pass a class or an entrepreneur just trying to manage your books. The question is always the same, right? Which account do I debit and which one gets credited? It really does feel like a puzzle with a million little pieces. But here's the thing. There's a simple, elegant key that solves it every single time. So let's just get it out there. Why is this so confusing? It's a question I hear from practically everyone, no matter what their background is. But you can relax, because all that confusion, it ends right here, right now. Let's get straight to the solution. Okay, let's crack this code. And the first thing you need to do is forget about memorizing hundreds of complicated, specific rules. That's not the answer. The real key, the entire system, it all boils down to classifying everything into just 5 types of accounts.
And honestly, this is the big secret. Every single business transaction in the world, I'm talking about buying a building, selling a product, paying a salary, anything, it can all be sorted into one of just 5 simple categories. If you can master the art of classifying, the rest just falls into place.
And here it is, the magic number, 5. That's it, just 5. You don't need to be a math genius or an accounting wizard. All you need to do is really understand these 5 major account types. If you can get this, you've literally built the entire foundation you need for everything else. So, you ready? Let's meet them. These are the 5 fundamental players in any business deal. You can think of them as your essential accounting toolkit. Once you know these 5, you can break down and understand pretty much anything that comes your way. First up, we've got assets. An asset is basically anything your business owns that has value. So you've got the obvious stuff, right? Cash, buildings, land. But here's a key thing. It also includes money that other people owe to you. So if your friend Rahul owes you money, that IOU, that's actually your asset. Next, you've got liabilities. And these are pretty much the flip side of assets. A liability is any amount your business owes to someone else. Think about a bank loan or money you owe to your suppliers or even salaries you haven't paid your employees yet. It's basically any claim someone else has on your money. Okay, now for the fun one, income. This is as simple as it sounds. It's the money your business earns from its main activities. This could be revenue from sales, maybe some interest you earn from a bank deposit, or commissions. This is why you're in business in the first place. But of course, you know the old saying, you've got to spend money to make money. And that's exactly where expenses come in. An expense is just the cost of running your business, all the things you have to pay for, like rent, salaries, and travel, in order to generate that income. And finally, number 5, we have capital. Now this one's a little special. It represents the owner's personal investment in the business. So when an owner puts their own money into the company to get it started or to keep it going, we track it right here. You can think of it as the owner's stake in the business. Okay, you did it. You've met the 5 key players: assets, liabilities, income, expenses, and capital. Now for the really, really cool part. Believe it or not, all you need are 2 simple rules to handle any transaction you can think of. Are you ready for them? This is it. These are the 2 golden rules that run all of accounting. On one side, you've got assets and expenses. For them, it's simple. When they increase, you debit. When they decrease, you credit. Now for the other 3, liabilities, income, and capital, and you can remember them with the acronym LIC, like LIC, it's the exact opposite. When they increase, you credit. When they decrease, you debit. That's the entire system right there. So theory is great and all, but let's actually put this thing to the test. Let's take our 5 categories and our 2 simple rules and apply them to a real-world business transaction. This is where you'll see just how powerful this framework really is. Okay, let's say you paid a salary of 50,000 rupees in cash. So step 1, what are the 2 accounts involved? Salary and cash. Step 2, let's classify them. Salary is an expense and cash is an asset. Step 3, what's happening to them? Your expenses are going up and your asset, cash, is going down. So now we just apply our rules. An increase in an expense is a debit. A decrease in an asset is a credit. And there's your entry. Debit salary, credit cash. See? Simple. All right, let's do one more real quick. Let's say you took a 40,000 rupee loan from Rohit, and you got it in cash. So the two accounts are cash and loan from Rohit. We classify them. Cash is an asset and the loan is a liability. What's happening? Your cash is increasing, but your liability, what you owe, is also increasing. We just apply the rules. An increase in an asset is a debit, and an increase in a liability is a credit. So we debit cash and we credit the loan from Rohit. It's the same exact logic every single time. And just like that, you have the key. You really do. Classify the accounts, apply those two simple rules, and you can unlock any journal entry that comes your way. It's not some big secret code anymore, it's just a system. So the next time you look at any transaction, you know exactly what the first question to ask is, right? Which one of those 5 categories does it fall